Good morning, everyone. Thank you for joining. Let's see, we're at 9:04, so let's go ahead and get started. I really appreciate your tuning in for this session on accessing private capital for early stage innovators. Before we get started, let me just make a few quick housekeeping announcements. First, let me remind you that this session is being recorded and we'll be later uploading the session to the Water and Energy for Food website and YouTube channels. There's a Q&A box on the right-hand side of your screen, and we encourage you to submit questions and comments in the Q&A box at any time throughout the presentation. And we'll be trying to answer them as we go along and also in the Q&A session at the end. And then also, I would like you to know that we're doing simultaneous translation in Arabic, French, German, Spanish, and Swahili. And this is available through the closed caption option. To turn these on, you have to select captions and subtitles, and then use the closed caption option icon in your video controls. To change the caption language, you can select settings in the icon and then captions and subtitles to choose your preferred language. Perhaps we can share those instructions in the chat box if anybody would really like that in more detail, because I know that's a little quick. So let's go ahead and jump into this presentation. First of all, let me introduce myself. My name is Augusta Abrahams, and I'm the program manager for Powering Agriculture. Jeff, next slide, please. So today's agenda, very briefly, I'll give an introduction, then the bulk of the presentation. We'll do a Q&A session and then closing. Next slide, Jeff. Let's go to the next slide. So as I mentioned, I manage Powering Agriculture, a grand challenge. And this work has emerged out of that program. Powering Agriculture was created to support innovations that can provide access to reliable, affordable, and clean energy to farmers and agribusinesses in developing countries. The real focus of the program was on technology and business model innovation. And implicit in the model is the idea that at some point, we would like to work ourselves out of a job as donors, and that these agribusinesses and innovators are going to be able to scale their solutions and technologies through commercial means. So we recognize that one of the really critical resources for these innovators is access to private sources of capital. As they grow and as they have developed their technology, how are they going to scale and really provide their technologies to larger swaths of constituents and beneficiaries? And that's by growing through access to capital. And so by the end of the 6 years of Powering Agriculture, we have some significant insights from these innovators about how they can access capital, what are some of the opportunities, but also what are some of the barriers. So towards the end of the program, we engaged in this research and wrote a paper on the experiences and included some external research, and are looking forward to sharing those findings with you today, and then also telling you how these results and understandings can lead into the Water and Energy for Food program that is just getting started now. So with that, let me hand it over to Jeff Engel, who worked with us on Powering Agriculture as a portfolio manager and provided business technical assistance to many of our innovators, and also led the bulk of this work. Thanks, Jeff.
Thanks, Augusta. I appreciate the introduction. Welcome, everybody, to our presentation today. As Augusta said, I was a portfolio manager as part of this program. In doing that work, a lot of my work centered on helping these organizations become investment ready, as well as helping them, to shore up business models and do the general business development kind of work that it was expected of the for-profit enterprises that were in the program. As Augusta said, We engaged in some knowledge products towards the end of the program, and the one I'm presenting today will be linked. It is one of the links in the chat, and you can find this full paper if you want to read further into it. So the Access to Finance paper that we wrote, we had two questions. One, we wanted to understand what the barriers were that were preventing these early stage innovators from accessing capital. And then we wanted to ideate and put some concrete solutions around what sort of support would actually help these early stage innovators in accessing that capital. So kind of a how-to guide for technical assistance, both at the tail end of the Powering Ag program, but also to serve as a guide for future programs such as Water Energy for Food. So in doing this paper, we came at it from a number of different perspectives. We did a literature review that was passive, in which we looked at kind of the macro trends that were happening in the market, what was happening in the financial markets, where was capital going in general. We added to that a series of interviews that we did with different stakeholders from the community we were trying to better understand. So I spent a lot of time, which I do in my normal work anyways, but a continuation of that was spending time talking to investors. These were not necessarily all investors that are in the clean tech or clean energy space. I was trying to source as many different perspectives as we could. So some of them had geographic specificity that coincided with our innovators in the program. Others had domain expertise. Some of them were completely unrelated. They may have been tech investors in which we had, no technology, true tech type companies in our portfolio. So we sourced information from a series of investors. We also, of course, wanted to talk to innovators to understand what their barriers were, what they felt their barriers were. And then we talked to some people who were connected to these programs. So these might be donor organizations, people from GIZ, for example, people from USAID who have expertise in the management of these programs, and as well as supporting these innovators. We took all of that information, put it together within this paper, and then again, out of that surfaced a series of barriers, and then we put some solutions around those. Okay, so the key things that we found during the research, availability of funding is not the issue. There is clear and strong evidence that's presented throughout the paper in which the amount of private capital that's available for investment right now in the macro markets is a larger amount than has ever existed in any of our lifetimes. So what that means is that there are these increasingly larger pools of investment capital that are kind of floating out there that innovators are trying to access. That's both good and bad, and we'll talk about both sides of that coin as we continue here. I'll get into that into that in a little more depth later. In general, the findings, at least from our program, was that the innovators who were positioned to secure funding, this meant that they had a working business model, they had plans to deploy capital, they had management in place, they had clear evidence that their technology worked, kind of these fundamental factors in determining investability. Innovators that had that were successful in raising follow-on capital. The Powering Ag program mobilized just shy of $70 million of that type of capital during the trajectory of the program. So the key takeaway from that research was that even though funding is available, there's more and more competition because there's more and more innovators that are out there. There's more and more global competition for this capital. So the chart that's on the right, that's on this slide, kind of shows what that's creating. That's creating these downward trends in number of deals. Okay, so the overall total number of deals is going down. However, the capital that's going into each of those deals is increasing. So in summary, that's basically saying that investors are wanting to put in larger amounts of money, but in a more dispersed pattern, a more concentrated pattern. So if before they were making 10 deals, now they might only make 5 that are twice as large, if that makes sense. So that's what that graph on the right-hand side is showing, and we're seeing that at all levels. It doesn't matter if it's seed capital or later venture capital. The number of deals are decreasing, and that's important for innovators because it's telling us that this competition that's out there is coming from all directions. That innovators, to access this money, need to have a strong business case, longer, more detailed proofs of concept. They need to show that there's a path to profitability. There were some other things that I mentioned a minute ago, things like management, that is extremely important as well. So those were kind of the big takeaways from the macro market level research. Our interviews yielded slightly different information, well, not slightly different, but corresponding information. The things that we took apart from the interviews, and this is mostly perspective that came from innovators and investors. But the insights I think describe what the problem is with accessing capital if you're these innovators. So a lot of our early stage innovators in the program had very limited expertise in how to access capital. They were technologists or scientists or researchers, brilliant people with a skill set that is not necessarily the same skill set of someone who would be, like a CFO of an organization or an investor into an organization. So that limited expertise actually gave them a barrier of not knowing, not understanding fully what financial markets look like and how they operate. Another issue that we found is that the innovators were not aware of what kind of funding is actually available. So they weren't sure, whether it be in their own geographic markets or it be at their stage of development, they weren't sure which types of capital they should go after. And a little bit of that is a language game in that, we use these different terms: venture capital, seed capital, risk capital. What does all that mean? There's a little bit of language challenge in that if you're not from that world. And then the fourth insight that we found was that a lot of innovators, when we talked across different programs, they received relatively inconsistent investment support. So myself and my partner, who was the other portfolio manager on the program, we have a deep background in raising capital. So we were able to provide our innovators pretty specific, measurable technical assistance through the program. That wasn't necessarily the case across, the general technical assistance supporting environment. So if you had someone that could coach you through it, that has that sort of background, that made a big difference in what the outcomes were for the innovators actually being able to access that capital. Included in the paper and also included as kind of a standalone knowledge product that we can also link to was we put together some funding milestones. These funding milestones are again, it's a guide. It's not the gospel. There's some room to kind of argue about what these different milestones are and slide things around. But in general, it gives you an idea of where a company should be, the capital that they should actually be pursuing at that stage in time, what the market should look like, and kind of where they are in development. So if we think back to the Powering Ag program, a lot of the portfolio that I was working with was in between prototype to pilot, some also starting to create revenue, having early manufacturing. They'd validated some sort of product market fit. And then if you look down to what kind of capital they should be trying to attract, it was that seed stage capital, which is typically kind of the first round of external money. That's money that's not just coming from what we call friends and family or from the innovator's own sources of capital. This is external capital. Or they were trying to approach something called Series A. Series A being kind of those first $1 million and above rounds of capital. That again, it comes from an external source, and it's specifically designed to accelerate growth. So that's what that's when you start hearing about venture capitalists. Venture capitalist wants to come into an organization, put money into that organization, and that money needs to be used as an accelerant for what that growth is. So they're coming in to put in money with the sole purpose to accelerate the growth of what that company's doing. Oftentimes in creating the capacity for additional manufacturing, which then would give the opportunity for additional sales, or getting the product more dispersed into the market. That's what a venture capitalist is looking to do, and that's this type of company and type of organization we were dealing with most often in Powering Ag. So just so you have some perspective on what these organizations in the program looked like, I thought this chart was helpful in describing that. Okay. So some barriers. Let's talk about the actual barriers that we found. We identified four specific barriers in they're listed on the left. Investor fatigue, that was the first one. Investment and credit readiness was the second. Deficiencies in investor discovery was the third. And profit motivation was the fourth. So I'm going to go through each one of these and then spend a little bit of time on describing what this barrier is, and then describing some opportunities that we found for support for these organizations. Before I move on to that, I wanted to point something out on the right. I've included a table here from the Journal of Small Business Strategy. This was a survey that was conducted in which the authors of the research basically handed angel investors a blank paper to say, hey, what do you think is important when you're evaluating an investment opportunity? Again, this is angel investors, which sometimes are the first money into an organization after the founder. This was a list of the things that they thought were important, and you can see the number of times that entrepreneur, meaning the individual who's at the head of the organization, the importance that they place on that. So trustworthiness of the entrepreneur, that's number one. Management team, number two. Again, that's the people involved. Enthusiasm of the entrepreneur, that's the innovator. Again, the first time we really see something that's not about the person themselves is when we start looking at things like exit potential. Is this something that can actually be sold off and liquefied later to get that return back? And again, then we have a few more connected to the entrepreneur. What I thought was interesting about this table was that product and the overall competitiveness of the product, so that would be the technology itself, actually ranked very low on the angel investors' criteria of what they thought was important. We don't even see it until number 10. That's very counterintuitive to what an early stage innovator focuses their time on. So let me say that another way. A lot of innovators at the early stages of development are focused on their product and solely their product or technology. Yes, that's important. It's clearly an important component of building a business, as in you must have something to sell, and that thing must be of quality that people want in order for people to buy it. That being said, it ranks very low on what an investor is actually interested in. So there's the human aspect of the business that until that is shored up and propped up and made clear that this management team knows what they're doing and has the skill set to grow this, well, the rest of it is kind of a moot point. So I'm oversimplifying here a little bit, but that was the takeaway I wanted to share from this journal article, is that counterintuitive to what innovators think, investors are very concerned about the team, and they're very concerned about the people who are leading the organization. If those things are not in place, the rest of the details become kind of inconsequential. Okay, so let's talk about these barriers. The first one, investor fatigue. Investor fatigue was a situation that we found specifically in the clean energy and ag tech space. And that had to do with investors who were very early to make investments in these markets, not being able to get returns that were adequate and that they were expecting in the timeline that they expected to get those returns. So when you build an investment fund, you typically have an investment time horizon. You say, okay, we're going to deploy the fund over X number of years, maybe 2 or 3 years, and then we expect to start seeing returns in the next, 3 to 5 years after that. The whole fund will have a lifespan of 7 to 10 years. Well, some of these investors that we were interviewing have been in these spaces for 10, 15 years making investments and still are without sizable exits to prove that their thesis of investing in these technologies was actually the right thing to do. Now, there's some other reasons why maybe these sectors don't generate exits as quickly. A lot of these investors were working in developing economies. Things take longer there. All of those are very apt explanations for why these returns haven't materialized. That being said, it's creating a loss of appetite for additional deals. So for a lot of these investors, they've been in this space for a long time. They have a portfolio of technologies. They're waiting on exits. And so they're just not making new investments. They're kind of burnt out because they haven't seen the returns. So opportunities for that. I think it's rather intuitive what the opportunity is. It's to introduce new investors. And these new investors, this kind of new blood, if you will, can come from a number of areas. So it could be that those new investors are looking for exposure to the geographic region in which the innovator's operating. We saw that in East Africa, in which there's external capital that's looking for access to East Africa because of the growth potential that's in that part of the world. So it may be that the investor doesn't have domain expertise as far as the technology, but they're interested in the geography itself. That's an example of a new investor that could come into the region. There is an opportunity for really for technical support professionals and people like myself and some of the other portfolio managers that were a part of this program, is that these innovators would have a very hard time finding these new investors that they don't even know about. At the same time, the investors are struggling to find a place to get a foothold in some of these geographies. Somebody that's a liaison in between those two sides could really accelerate that process. So that's a good opportunity for concrete, measurable technical assistance outcomes in these types of programs. And that's what I listed as the third opportunity, is that, make sure that these programs have investment liaisons who have established relationships with investors. And then if those relationships are maintained, then you have an understanding into what the investors are looking for and maybe deficiencies that the technical assistance provider in the program can play matchmaker. That would be hugely valuable to a lot of these organizations. The second one, investment and credit readiness. We saw this, and I kind of talked about it with that table that I showed with the angel investor criteria, is that first-time innovators, they don't know how to position their company for fundraising. They don't know what things are important to be considered investment and credit readiness. Investment and credit ready. They they think that technology is the most important thing, or they think that because they've done a pilot or two and have some proof of concept that they're ready to go out and raise capital. That's not typically the case. So innovators almost always think they're more developed than they are. And it takes somebody to come in and say, okay, look, you have you thought about this? Have you thought about this? Have you thought about this? To get them to do kind of a reality check on what their actual level of development is. So some ways to help with that is to provide some targeted trainings to build financial understanding. So Augusta did a nice job with this in the Powering Ag program, and that we had a series of events, and at each of those events and conferences we had certain training dedicated to investment readiness. And it served as a backdrop to help innovators understand, what they were missing. The second opportunity is kind of what I described with the technical assistance. Again, the one-to-one technical assistance, if you have someone that's supporting you that understands what investors care about and the milestones that they care about, you can help an organization to highlight that and or work to achieve those milestones so that they become relevant in the mind of the investor. Okay, and that kind of goes back to that chart that I talked about with what are the milestones connected to what kind of funding. Helping deliver technical assistance to align those two is hugely valuable to innovators. And then the third one, again, is just like a quick, easy to do piece of support. These innovators need to have deal rooms. It's an industry term that we use. It's basically the repository of documents, things like executive summary, shorthand business plans, financial statements, founder statements, mission statements, all these kind of documents and things that an investor is going to expect to have access to. You want to have that stuff gathered and sitting in some sort of repository that you can continuously update. In doing so, you're demonstrating that you're capable of managing those types of resources within an organization, and you're also prepared for when the investor says, yeah, sure, send me your deal room. And if your response is, what's a deal room? That conversation is not going to go much further than that with the investor. So again, another kind of concrete opportunity to provide technical assistance to innovators in helping them create those repositories. Yeah, the third one, deficiencies in investor discovery. This was a series of, this came up continuously in that the innovators don't know where to find investors. So they're not necessarily running in the same circles. Yes, there are events in which, things like SOCAP that happens in California where you've got investors that are in the space come together with innovators. That's a great example of an event where that happens. That happens once a year. So you need to find ways to be able to find investors outside of those events. One of the struggles that innovators have in doing that is that they don't know how to have those conversations when they do meet an investor. So they start talking about, their technology, or they start talking about some of the stuff that they've done in the market. That's good. Investors may also be interested in, kind of what you're doing financially, where else you've received money from. Do you have any other money in? There's a different understanding and a different conversation that investors oftentimes want to hear than that of just the enthusiastic innovator who is describing what their opportunity is, and they're describing this, cool new technology that they built. That might not be the conversation that investors want to have. So the opportunity to do this is engaging local and regional financiers as early in the process as they can, and that's an opportunity for innovators. Innovators should be talking to anyone that they can talk to related to money. They should be tracking that, putting it into Salesforce or putting it into some sort of relationship management software. Again, trainings, which is something that we provided throughout Powering Ag. That's a great opportunity to help innovators understand the differences in these mindsets. An investor thinks differently than an innovator. They fundamentally do. And bridging that gap is a bit of a language translation in how you can get these two sides to talk to each other. And that leads to the third one, that just make sure that as an innovator, you're having the right conversations with the right types of funders. And that goes back to that chart that I showed, which talks about who's funding what at which stage of development. Those are all opportunities for support. Okay, and then the last one was profit motivation. So we were dealing with, we were dealing with innovators who were oftentimes part of donor-funded programs. Those donor-funded programs may have outcomes that are not totally market-based. They may have, social outcomes or even political outcomes that they're hoping to achieve. In those instances, we need to delineate between an organization that is designed and set up and working on social goals versus, or social or political outcomes, versus organizations that are designed and developed to create profit. So if you're going to try to attract investment that is private follow-on capital, you're going to need to demonstrate that there's some pathway to profitability. And if you can't do that, then I think there's two things. One, you may want to evaluate what is this organization's purpose. And then two, if the answer is that you're not anticipating making some sort of profit with this, is that just because it hasn't been brought up? You haven't thought through it? Is the opportunity there, but maybe the innovator doesn't see it? So again, another opportunity for technical assistance with this type of innovator is to ensure that the goals they are pursuing match what the expectation is for later in the company. If the company or the organization believes they're going to raise capital and that they're going to need to raise capital, they need to have a certain focus on profit from the beginning. It can't come too late, because at that point they will have already hemorrhaged cash and probably will be more desperate than had they looked at it from the beginning. Okay, so those were kind of in detail the four barriers that we found. Some additional opportunities for technical assistance. This is just kind of a quick overview of what I've talked about in more detail before. But asking too early. Innovators think they're further developed than they are, almost always. So they go out, they start asking for capital, they start trying to go through a fundraising process. They're not actually ready to do that. It looks negatively on them because it demonstrates to the investor that they don't have the financial acumen to understand where they should be in development before asking that question. Okay, that's important because that creates a mismatch between, again, that investor mindset and that innovator mindset. The second opportunity, asking too little. This goes back to what I talked about very early in the presentation, in which investors are making fewer deals, but they're making them in larger quantity per deal. So those investment rounds are going up. So if you're an innovator, you need to be looking at what is the appropriate ask for how much money, and make sure that you're asking enough. So we see it all the time where an innovator thinks, oh, well, if I just had another $10,000, I could produce, X number of the product and I could sell it. That's not interesting to an investor typically. And here's why. They, as an investor, have to do due diligence at the same level, more or less, whether it be for a small, say, $10,000 deal or whether it be for $1 million deal. If you're sitting on a large quantity of capital and your fund is trying to deploy this money, your time is better served working on a bigger deal. And that's what we're seeing with overwhelming evidence in the market, is that deals are getting bigger, but the number of them is decreasing. So the size and the actual price tag is going up. If you're an innovator, make sure you're asking for enough capital. And in doing that, you need to make sure that you have a plan for deploying that capital. Okay, that's the other piece of that. Okay, the third, asking the wrong sources. Again, this is an opportunity to help innovators understand the difference between like debt and equity. A lot of innovators, if you ask them, where are you going to find money? They say, well, let me go to a bank. Well, okay, that's not who's going to fund you early. In fact, a bank doesn't come in until very late in a startup's development pathway. So make sure if you're working with these innovators that you're helping them to understand, again, back to that earlier chart, what funding goes with which stage of development and where does that money come from? Is it coming from angels? Is it coming from venture capitalists? Is it eventually coming from a bank? Make sure you're aligning those different milestones with the different funding that's out there. Okay, so that's really the bulk of the paper. I'd encourage you to download it and read it. There's some things that are highly relevant for today. And anybody that's working with innovators, I think should have an understanding of what these barriers are and opportunities. If you're an innovator yourself, you're going to come across some of these barriers, and perhaps this can be a resource in helping that. Before we close out, I just want to go through a couple things because we're living in an interesting time right now with the global pandemic. But it's not the first time we've had market disruption because of some sort of macro event. So if we think back to 2008, that seems like a lifetime ago. It actually wasn't that long ago. We experienced similar challenges in 2008 when we had the global financial crisis. So what happened during that was that markets got disrupted, lending tightened, investment tightened, valuations for companies went down, unemployment went up, recession occurred. It sounds very similar to what's happening right now in our global economy and certainly what's happening domestically. Domestically being in the United States. That's the perspective I'm speaking from here in this. So one of the things we learned from 2008 is when these events happen, investors kind of pull their money off the table and wait because they want to see what's going to happen. It's not a great time to be making bets. And we're seeing that. The investors that I deal with and the people who I'm in communication with on a regular basis, where I am trying to understand what their world is like, what deals they're making, what things they're seeing, a lot of them have suspended making investments. It doesn't mean that they're suspending that forever. It means that they're suspending it for now, for today. They're waiting. They're being patient. Remember, investors can usually negotiate a better deal the longer they wait if the organization is in need of cash. Things get cheaper, so they have some advantage in doing that. And then the last thing from 2008 is just the concept of winners and losers. We're seeing that in the public markets. There's never been a better time for Amazon than during COVID, for example. So you're going to have these winners and losers that happen in any sort of economic disruption. So what does that mean for us going forward? Well, opportunities beyond COVID. There's the saying that cash is king. This is both for the innovator side and the investor side. Investors are going to have the ability to make significant deals at lower valuations at the tail end of the pandemic, that if they're sitting on cash, they're going to aggressively be looking for opportunities. Also for organizations, if they have cash in their accounts, they're positioned to survive this. So the capital, again, is looking for opportunities. Cheap debt right now is available because that happens during these sorts of economic events. Stress testing and risk management. A pandemic is a great example of a stress test for an organization. How are they going to manage risk like this? This is not going to be the last economic event that we suffer as a planet. We saw 2008. Here we are 12 years later. We have a different version of the same problem. And then the last thing, and I think this is maybe just a great takeaway for this presentation in general, is that companies who can demonstrate value propositions that are clear, that have market traction, again, that have management in place, their technology's working, they're clearly showing a market opportunity, those companies are going to succeed today, yesterday, and beyond COVID. That's what investors are wanting to fund, is companies who can demonstrate those specific ideas. We saw it in our program. We see it continuously all the time. Companies that are developed and have clear understanding of what they need and at what point in time are able to raise capital. And there's no reason to believe that on the back end of this pandemic, once it finally kind of loosens its grip, there's no reason to believe that that won't be true. So that's going to continue to be true going forward. Okay, I think I will stop there. Let me turn it over to Gianna. Yeah.
Thank you very much, Jeff.
Thank you.
My name is Jana Schneider, and I work in Bonn in Germany for the GIZ Secretariat Unit for Water and Energy for Food. And I want to quickly, so we still have enough time for the Q&A, explain how we, as the new program Water and Energy for Food, incorporated these lessons learned that we just learned about, that we just heard about from Jeff, into the program design of WE4Food. If we move on to the next slide. Let me quickly, Jeff, if you could go on to the next slide. If we look at, I will just quickly introduce WE4Food as a whole to you. WE4Food is a successor program of both Powering Agriculture and the other international initiative Securing Water for Food, and brings together the aspects around water, energy, and food. It's a joint national initiative between Germany, the Netherlands, Sweden, and USAID, and was launched in 2020. We meaning GIZ and USAID, implement 4 hubs in East Africa, in West Africa, South and Southeast Asia, and the MENA region. So our mission basically is to expand the sustainable scale of innovations that impact the sectors of water, of energy, and of food, in order to increase the sustainability of agricultural value chains, address environmental and climate resilience, and all of this with a particular focus on the base of the pyramid, meaning the poorest of the poor and also women. So if we move forward, Jeff. WE4Food has different areas of interventions, and just quickly, I want to show how we expand the interventions, the areas of interventions of powering agriculture and securing water for food. We still support our innovators with direct grants. We go into public-private partnerships with the private sector. We offer technical and financial assistance to the innovators that we support. We also offer capacity development in a broader sense. We also participate in the global knowledge management around the aspects of water, energy, and food through knowledge generation and facilitation, dissemination. And we also make sure that our innovators actually have the perfect environment, enabling environment in their countries, in their regions, and also globally in order to upscale the innovations. Next slide, Jeff. So just to quickly go through the program goals, the objectives of our program, it's to increase the food production, increase the income, especially, as I mentioned, for the base of the pyramid, women and men. Support our innovators in sustainably scaling their innovative solutions in order to promote climate and environmental resilience, and of course, protect biodiversity. So let's look at how we as WE4Food actually incorporated these lessons learned that we heard from Jeff into our program design. If you go to the next slide, thank you very much. So for example, we've heard that innovators often struggle in accessing finance, accessing additional investments. So we as WE4Food made sure to have, and this is just an extra from what we're actually doing, to make sure that our innovators have all the capacity that they need to attract additional investment. So for example, by facilitating relationships between innovators and investors, for example, by organizing matchmakings, targeted matchmaking events, and other networking events. We also provide technical assistance in regard to investment readiness. So as Jeff mentioned, to make sure that our innovators meet investors and bring to the table what they need to actually mobilize additional investment. So for example, train them in making pitches to investors. In order to make sure that both innovators, but also end users, so basically customers of the innovators, are able to access finance, we make sure that we actually establish partnerships with financial institutions. So we have these partnerships with, so we will have these partnerships with financial institutions, which, for example, can then develop targeted products for both end users and innovators. For example, it could be a microcredit for a solar technology. So, and lastly, we also make sure to sensitize the staff of financial institutions towards the needs of both the innovators and the end users. So this was just a very quick overview of some of the activities that we do to make sure that we support our innovators even better in making sure they can upscale their innovations. So I think we will turn to Augusta now and back to Jeff for the Q&A.
Great. Do we have some questions, Jana? Or I can't see them in my chat window, but.
Yep. So Jeff, we have gotten one at this point, and it's a good question. So the person asks, were there any specific tools you use to help innovators develop/adapt their business models, e.g. business canvas and lean canvas, etc.?
Yeah, so we did that as an exercise in the conference that we had when we were in Kenya when we met. One of the sessions was on business model canvas. I'm going to say two things about business model canvas. One, it's a tool that I think is useful in getting an innovator to think about their business from a different perspective. So it's one of those things that you can't see the forest for the trees. If you're working inside the business every day, it's very rare for you to have an opportunity to step back and look at everything from 30,000 feet. That's what business model canvas can allow you to do in providing technical assistance and and using that tool. What I don't like about business model canvas is that it oversimplifies what an organization should actually look like to be investment ready. So here's an example of that. An innovator might take a business model canvas and it's broken down into its individual parts. And if they think, oh, well, I just need to get something in each one of these boxes, and as soon as I have something, the quote unquote correct answer in these boxes, I'll be investment ready. I think business model canvas is useful for assessing the business. I don't think it should be considered the be all end all tool for actually being investment ready. So there's another tool that we used or I use internally with the innovators that I work with, and it's called an investment readiness checklist. And it's basically a series of prompts that an investor is going to ask these innovators at some point. These issues are going to come up either through due diligence or through the initial interaction that the innovator has with the investor. So this checklist that I have created and added to and used allows those conversations to happen between a consultant or whoever's providing the technical assistance and the innovator before they go out to try to approach investors. It's kind of a warm-up and preparedness activity for what those early conversations are going to look like. So that would be an example of two different tools. If you simply Google investment readiness checklist, you'll find different versions of the tool that I'm talking about. And people have supplied those. You can take them and modify them. I have one version that I use, but it's by no means the only version that's out there. So that would be an example of two.
Thanks, Jeff. So another question is around the larger scale of investments. Our questioner asks, since investors are increasingly looking for larger scale investments, is there an opportunity for facilitator to consolidate, curate, and package multiple small or medium scale size investments into a single deal for these investors. Have you seen that in practice?
I don't know. I'm thinking of mechanically how that would work. So an investor is going to want to do their own due diligence on each one of those deals. I think that presents the challenge of how do you effectively, or how do you efficiently get through a due diligence process on a number of deals. There certainly could be there certainly could be a number of examples of that. I have not come across something like that. I'm sorry if there's an example out there. I'm unaware of it.
You know, what I might add to this is, and Jeff, feel free to expand, is that a lot of times this is how capital initially enters the market through an investor. So you have, say, a pension fund that puts their money into an investment fund, and the fund is essentially packaging these deals, but they're doing it on they're not packaging the deals, but they're providing this entry point for the original source of the capital. And
Sure.
One of the things I know, working with the investment funds that we've worked on in Alpha Mundi and Factor E under Pairing Agriculture, is that they really see themselves as entrepreneurs too, because they're constantly trying to raise capital from the original sources of capital. So in some ways, this is the role of impact investors and others, but maybe not exactly along the lines of what the questioner was asking. I don't know if you want to say more, Jeff.
No, that makes sense. That something like a pension, that's a good example of a pooled investment. And I think the investment alliance that you spoke of as part of Powering Ag, they're behaving in some ways they're behaving in an entrepreneurial way, I would say the answer to the question is that, yeah, there probably is a role for facilitating that. If you had the ability to curate those deals and kind of put them together as a package and then almost go shop them in mass, that could be an interesting value add to the innovator. And there are people who do that. There are consultants who package deals and then take them out and shop them. I don't know about doing it as some sort of pool. I think that's where mechanically I'm struggling to see how that would work. But certainly there's a role for liaisons and people who can help package deals. In fact, that's a lot of the technical assistance that we were providing through the programs, was packaging these deals to then be able for the innovator to go out and shop them on their own.
So it looks like we have time for one more question, and luckily that's just what we have. So
Okay.
From Mr. and Ms. Gopal, and feel free to elaborate on this more in the chat. The question is if funding raised from distributors also considered investment funding, and I believe the question is getting at sources of funding eligible for nonprofits, because the questioner asks if nonprofits are eligible to compete. But maybe you can elaborate more broadly on sources of funding for nonprofits when you answer this, Jeff.
Okay, so a couple things. When I hear the word distributors, I'm thinking of kind of like trade credit. So there's a speech bubble or an outline bubble in the presentation that talks about how trade credit becomes one of the more important sources of capital or was identified as one of the most important sources of capital for our innovators that were in the Powering Ag program. And what that essentially allowed was it allowed distribution and sales to happen without needing to go to traditional financing sources like banks and/or investors to get trade capital. Trade capital allows transactions to happen when the cash isn't provided upfront as the payment for the good or service. That was extremely valuable to several of our organizations, and that's a model that definitely works when it comes to nonprofits. That is an available source of capital for a nonprofit to use, and we have some examples of those in the Powering Ag program. As far as other sources of capital for nonprofits, certainly a target would be grant funding. donor-based funding, specific funding that has a social or some sort of environmental or political pursuit behind it. Those would all be sources of capital. Do you have any thoughts on that, Augusta?
Nope, not on my end.
Okay.
Not on my end. You've now reached the limit of my expertise.
Okay.
Okay, so with that, I think we've come to the end of our hour. Once again, I thank you all very much for joining us. I hope you found this useful. Reminder that the link to the paper was shared previously in the Q&A box, and that this will be posted. The entire webinar will be posted on our webpage and YouTube channel. And we'll be providing some written responses to Q&A at that time too, and hopefully can provide, I see a question about the link to the business model, the investor readiness checklist, and so we'll respond with that then. So I don't think there's anything else on our end. Jana, is there any final thoughts before we finish up?
Just a very warm thank you to everybody attending, and I think it's great that we are having these sessions, learning from the past and thinking about how we can basically make our programming around water, energy and food better.
Thanks again, everyone, for joining, and thank you very much, Jeff, for the great presentation.
Thank you. Good luck, everybody.